Hello, and welcome to the ADM Investor Services Weekly Market Kickoff. Please note that the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or Archer Daniels Midland. Today's panelists are Alan Bush, our Senior Financial Economist, and Mark Soderberg, our Senior Ag Market Specialist. Starting with the grains, Mark, what has driven the recent surge in soybeans and soybean meal?
Well, heavy rains just continue to move across the same areas in far southern Brazil. Rio Grande do Sul, the second largest producing state in the country, is believed to have had about 25% of their soybean crop still in the fields before these rains arrived, with production forecasts of around 22 million metric tons. That would suggest about 5.5 million metric tons of crop were at risk due to flooding. While it's likely it's still going to be several days or weeks before we get a real accurate assessment of the lost production, I think we can, right now, best guess would be somewhere between 1.5 and 3 million metric tons. Prior to this historical rain event, there was already quite a bit of disparity between production estimates, with an 8.5 million metric ton gap between the USDA and CONAB. So where do these production losses come from? The CONAB number at 146.5 million metric tons, or the USDA forecast at 155 million metric tons. So all this uncertainty has really driven speculative traders to cover their short positions. Just 2 months ago, we were looking at a record large short position by soybeans by money managers, and in meal it was the largest short position in over 4 years. So the last CFTC report has showed still a rather sizable short position in soybeans, while in meal they flipped their position around, now likely holding over a 50,000 contract long position. So prices firm up here. It looks like we're going to challenge this 100-day moving average. We've blown through that this morning, and now look, this challenged a March high at 1240 in July beans and 380, which is a Fibonacci retracement level here in the meal.
All right. What are you expecting in Friday's WASDE report for corn and soybeans?
I look for corn stocks to drop about 25 million bushels to just below 2.1 billion. This due to higher usage for ethanol production. Exports, to me, they look like they're holding up well enough, and with all this uncertainty with production in South America, I don't think they're going to change that this month. I've got new crop production in corn just below 14.9 billion bushels, with new crop carryout growing to 2.228 billion. In beans, I don't see any change in the ending stocks this month. Got that at 340 million bushels. They did lower exports 20 million last month, and with this added production uncertainty now in South America, I don't see them changing that again this month. I've got new crop production at 4.40 billion bushels. Ending stocks growing to just below 400 million to 395. I've got lower production estimates for both Brazil and Argentina in corn, combined of around 6 million metric tons. I don't think they're going to change the Argentine soybean production. I think that'll stay at 50 million metric tons. I see them lowering the Brazilian forecast 3 million metric tons for now to 152, with likely future cuts coming down the road.
All right, and finally, what is your winter wheat production forecast?
I've got all winter wheat production at 1.340 billion bushels. That's up about 90 million from a year ago. This due to higher yields and a rebound in harvested acres from last year. The average yield works out to just over 51 bushels per acre versus 50.6 a year ago. Despite the dryness in the southwestern plains, we look for a big jump in hard red winter wheat production to about 725, with soft red being down to 405 million, down to 465 from 405 a year ago.
All right, thanks, Mark. Moving over to financials. Yeah. Alan, what is the policy outlook for the Federal Reserve and other major central banks?
Okay, well, in light of last week's Federal Open Market Committee meeting and Fed Chair Powell's press conference, it now looks like the Fed may be cutting rates a bit sooner, possibly at the September 18th meeting. And currently there is approximately a 68% probability that the Fed will be cutting rates by 25 basis points at that meeting. Just a few days prior, though, there was talk that they could wait till the November 7th meeting. So it has come in a little bit as far as expectations when the Fed may be cutting rates. So some of this change in sentiment is also linked to the softer than expected employment data on Friday. And as far as the European Central Bank, we did have an ECB governing council member over the weekend saying that interest rates could be cut 3 times this year, starting with a June reduction. Also, the Bank of England is also likely to lower interest rates this year. So I think central banks may be a bit more accommodative now than what we had seen about a week ago.
All right. Which markets have the most bullish fundamentals currently?
Okay, well, interest rate policies from the Fed, the European Central Bank, and the Bank of England seem to be becoming more in sync in that lower rates are likely this year, and a more accommodative central bank, or in fact, all the central banks are likely to become more accommodative, is a situation that lines up for the bullish side of the fundamentals for the stock index futures, which are looking better technically and fundamentally. This is also supportive to gold and silver, which are showing good gains today. So the markets that I would be concentrating on, once again, the stock index futures and precious metals have the best fundamentals with prices likely to advance going forward.
All right, Alan, and last question. For the financial futures overall, what are the most potentially market-moving reports for this week?
Okay, well, Tuesday we'll have the March consumer credit guessed at up 15.5 billion. Thursday jobless claims at 212,000. And then Friday we'll have the May consumer sentiment index anticipated to be 77.
All right, well, thank you both. Remember, the views and opinions expressed here today on this video are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. If you'd like more information about our brokerage services, please visit admis.com. Thank you.